Hey, good morning, everyone. This is Kirk here again at Option Alpha. Just a quick video update on comparing these market tops here. It's actually getting a little creepy how similar some of these technical areas of support, resistance, consolidation are getting on when you compare the Dow Jones in 2007, 2008, and when you look at the chart now. So I'm going to go over that in more detail here in the video, but what I wanted to focus on real quickly is again just this investor cycle that we all go through. And so again, no one's immune to this. It happens to everyone. It's probably happened to you numerous times. It's definitely happened to me. And the idea is that if you understand this cycle, then you'll have a little bit better anticipation of what's going to come down the line. And even though you may not profit, you definitely won't lose as much money as you did last time. Using my fancy new highlighter tool that I downloaded, the thing that I wanted to say is that I think where we're at here is we are beginning to be in the denial and an anxiety phase of the current market. And I told somebody last night on a coaching call that all these market tops are virtually the same. I mean, they really are. You go back in history, you look at all of them from the 80s, the 90s, the 32, 38, etc. You go back and you look at all these different market tops and you see that they're mostly all similar. They just have different catalysts, right? In 2008, it was the subprime mess, right? Now it's the Eurozone debt crisis and our own debt crisis that's starting to come down the line. So the point that we're at right now is, I think, the anxiety and denial phase. I think we've gone through the excitement and thrill of, hey, the market's rebounding. We've had a euphoria at the end of QE2. That's when I think the euphoria kind of really wore off. Now that we've started to really dip, it's a little bit of anxiety, some denial, right? Things you'll hear in the media are, the Eurozone is not really going to affect the U.S. We don't have much exposure. It's not really that big of a problem. It's being taken care of, right? But who knows? It's definitely a bigger problem than we all think. I think that once we get into the fear stage, that's when things get almost certain that we'll get down into another low. So again, if we don't hit that level, that fear and panic level, then I think we'll be okay and we'll kind of tread sideways to flat. But if we get down to that fear level, if we start to see some new lows being hit on the Dow and the SPX and some real hard selling by institutions in the beginning of next year, I think we could easily come down into those desperation and panic levels that we saw back in 2008 and the beginning of 2009 when the market bottomed. So again, just understanding how all this stuff works is really important. So if we actually go to the different charts here, this is the chart of the Dow in 2007, 2008. We are currently somewhere in this area right here, relatively speaking, in 2011. This is what is really facing and staring us in the face here. This is really why, for the trading alerts, I've been really conservative for members and trying to get as far away as possible, taking small profits, because that's what I did back in 2008 and was very successful in doing that. I was lightly positioned. I didn't overexpose myself to the downside, and I took a lot of time to buy protection and buy hedges for my positions back then. And so that is what really helped us get through 2008 and the better part of 2009. If you actually look, I think what's so crazy about how similar this is just this trend line right here, this big trend line that it followed for the better part of 2 years. And that's really what we had in 2008, or I'm sorry, 2009 and 2010 is a really good trend line. And then it started to break down, and it took a while for it to kind of roll over, right? We had some denial and consolidation here, and it took a while, but eventually it rolled over. If we fast forward to the 2011 possible top, again, you can see that this major trend line is here, and it's steeper this time. The one that we were just looking at before was more like this, right? It was more gradual. This one is more steeper slope. So it means that it's not sustainable in the least bit. You can't sustain that type of a slope indefinitely. But the same thing that we had then is happening now. This area of consolidation here is much bigger, meaning it's much more of a denial factor, right? We don't want to go into another recession, depression, whatever you want to call it. So it's taking a longer time for us to base. And when we move up, we keep getting hit at these levels. We keep hitting our heads on these resistance levels and just can't seem to break past that level. Now, again, if we take a look at 2008 and kind of relate as what could happen, we're looking at possibly a 2,000 point sell off in the Dow. That would take us roughly just below 10,000 by the first quarter of next year. Again, if this all plays out exactly similar to what happened, I think we need a pretty good catalyst to get us down to that level. Most of the news has been priced in, so that's my only disclaimer on this, is that most of the bad news is already priced into the market, in the sense that we all know that Euro debt crisis is bad. We all know that our own debt crisis is bad. We all know that unemployment is still high. So we'd need another bigger catalyst to get us down to that level. The one thing that's going to help and act as an area of support, should we start to sell off, is going to be the Fed. The Fed yesterday said that they're not going to help with any QE3 just yet, but they didn't rule it out. And so that's the one thing I think where the market could catch itself and kind of avert a major sell-off. So that's where I see things going in the better part of next year. I'm pretty risk adverse right now, in the sense that I have a lot of my positions are very conservative, mostly in cash. I don't want to overexpose myself to the downside right before it happens. So we're taking small, kind of nibbling type positions in the market. Really good positions here and there, but not fully invested in the least. So I would say the same would be for you. There's definitely going to be better opportunities to come. We all know that the market is not going to just continue this choo-choo train move higher. So I would be aware of the downside, as always. The VIX is fairly low right now. Means people are a little bit complacent, and I'm always concerned about that. So I'd rather be worried about the risk side of the trade than anything else. So as always, I hope you guys enjoy these videos, and happy trading.